you very much, sir. A big round of applause to you. Thank you. So thank you. Thank you, participants, for joining, for attending the program patiently, and so it's really wonderful. I learned a lot from the session. Okay, so thank you, Nagarede Garu. So let us start the next session. The topic what we are talking about is very interesting, very advanced. Supply chain finance. Okay, so a supply chain finance, a review of a state of art. Okay, so by Dr. Kalyana Chejarla. Okay, so welcome back, Dr. Kalyana Garu. Nice to see you again. So let me give you a quick introduction to you. So it's always pleasure to hear to you, sir.
Thank you, Abdul Garu. It is a pleasure to be
Kalyana Garu with 18. So Professor Kalyana Garu is he's over 18 years of experience in supply chain domain at Tata Motors, HCL Technologies, Tata Consultancy Services, and Dell International Services. He has dealt extensively with global customers and authored a book in lean management for small and medium-sized enterprises. Okay, published by Springer Nature, and he teach, he consult, and he advises organizations. So very nice to have you here, Dr. Kalyana Garu, and it's very interesting topic, supply chain finance. Okay, it's very rare. People don't hear about supply chain finance. Even the supply chain managers don't pay attention to the supply chain finance. So it will be a great pleasure to hear this topic from you at the right time. Okay, so thank you, and over to you, Dr. Kalyana Garu. The stage is yours.
Thank you. Thank you, Abdul Garu. I'll share my screen here and I'll begin my presentation. Abdul Garu, could you please confirm if you are able to see my screen here? And if you can hear me also, okay?
We can hear you very nice. We can see you. Please proceed, and we can see you also. So please continue.
Thank you. Thank you for confirmation. Once again, many thanks for that warm welcome, Abdul Garu, and it's a pleasure to be part of this series of summits that is being organized by Data Labs and Trucy. So as you mentioned, I was here last year also, and it was a very interesting conference that I was part of, and I'm happy to be part of this conference as well. I did get connect with number of key thought leaders as part of this particular conference. So thank you for inviting me here. And secondly, the topic of choice here, which is supply chain finance, as you rightly put. I had been to many supply chain conferences organized both in the academic world as well in the corporate world. For some reason, while everybody acknowledges that the topic of supply chain finance is critical and important for overall effective management of supply chains, yet from attention that is given to the topic in the conferences, it is still not adequate in my opinion. It is more as a sideline topic. So once again, congratulate you for making this a mainstream topic as part of the other presentations that are related to supply chain excellence. You can't, in my opinion, you can't achieve excellence if the finance side of supply chain isn't given due attention. So with that background, I have decided to sort of give a quick overview of the subject for the participants here. By no means this will be a extensive treatise of what is all that's there as far as supply chain finance is concerned, but surely I believe this 1 hour or just short of 1 hour presentation will give the participants some idea about what is it all about, and why is it important for a supply chain manager to pay attention to this particular subject. With that, let me move on. Mr. Abdul has already introduced me. I have worked in the corporate for about 18 years with various global companies and various industries in various geographies. And then for last 1 decade or so, I had been in the area of academics. I am an associate professor of operations management at Institute of Management Technology at Hyderabad. And I have also done my PhD from IIM Lucknow. Supply chain finance is one of my areas of research, consulting, and interest. I do, do as much as I can to stay abreast with this subject. As mentioned by Mr. Abdul a few minutes back, I have also recently, among other case studies and articles in the international journals, I've also co-authored a book on lean management, which any supply chain practitioner would agree is the need of the hour in making sure that the supply chains are operating in an efficient manner. So lean management gives a lot of useful tools, and none of them. So unlike one going for a, let's say, big size ERP implementation, which generally is has a big ticket item for most companies in terms of achieving operations excellence. Lean as a set of tools doesn't cost as much. In fact, it doesn't cost a lot at all. Yet at the same time, it does provide companies with some successes which they can plow back. I mean, whatever gains that they get in by implementation of lean in the initial stages, they can plow back and invest more in terms of process improvement, and new technologies such as Industry 4.0 and things like that can also be looked at as a subsequent stages of lean management. So that is all we have dealt with, and in this book we have particularly focused on how would small and medium-sized enterprises can go about implementing lean, what is the right methodologies, and what results can they expect. And rightfully so, my topic of presentation today, which is supply chain finance, is also very close to small and medium-sized enterprises, essentially because you will see as I move along, you will see that among various players that exist in any given supply chain, it is the very upstream folks that is usually the farthest from the customer, that is your SMEs, tier 1 suppliers, are the ones which are most affected for want of access to working capital. And the supply chain solutions that are up and coming are focused at solving these problems. So, the lean management for SMEs and SCF for SMEs are, in my view, are somehow related to each other, and I see some synergies in this talk. This is quickly about me and the background, and I'll now move on. I'm going to try and address these 4 questions or 4 subtopics in supply chain finance today. First is what is supply chain finance? My advanced apologies if you see that I get into some teaching kind of a mode, by virtue of my current profession as a faculty. Even if I avoid a little bit of that academic angle may come in, but I'll try to keep that to minimum. Yeah, thank you. So we'll talk about what is supply chain finance, and then we will move on to why should businesses care about supply chain finance, and particularly supply chain managers. And having figured out that we should pay attention, what kind of solution should we look at? That is a third question that we will address. And finally, a little bit on what's the state of art. I mean, what is the market size? What kind of solutions exist? And what kind of solutions are likely to come in the future? And how is, in particular, technology going to play a role in creation of newer business models that will enable all the, provide benefit to various stakeholders in a given value chain. So this is, I believe, a good 360-degree view of the subject within the limitation of whatever 1 hour that we have. Does this sound good, Mr. Abdul? I mean, as a set of
Yeah, please proceed. Yes, it's very interesting.
Oh,
yeah.
great, thank you. Okay, so first subtopic, what is supply chain finance, right? So before we get into supply chain finance, let's spend a minute on supply chain management itself. I mean, the very terminology, supply chain, is in some sense relatively new. Hadn't been there, I would say, about 40 years back. How or what drove this particular concept of supply chain in organizations is essentially to have a holistic view of how an organization operates in an ecosystem of partners, both upstream as well and downstream. So if you look at this diagram here, let me just change a pointer. Okay. So if you look at this diagram here, I mean, if you think of this as one organization, organizations are typically there to help the flows of materials or services, information. So these horizontal can be thought of as the flows of various types, and verticals can be thought of various divisions, subdivisions, and things like that. So right in the middle, what you have as midstream is our core organization, and upstream, that is inbound, is all its suppliers, and downstream is all its customers, or if not customers, whoever the organization sells to, that is your distributors, retailers, and so on and so forth. And if you see here, I mean, the two layers that are here, one is how the material information cache itself flows, but the second and important from a managerial perspective, a view that needs to be thought about is how in each of these stages is value being created on the product, so that the customer is finally going to get the value out of the entire exercise. So if this was the view, the prevalent view, at least before the emergence of SCM, was to make sure that or optimize only within the organizational level. But with the emergence of SCM, what people have started to realize is that no individual organization in silo or in isolation can be successful forever in the long run. So it needs to consider its position in the overall supply chain, and then collectively it must try and optimize the entire supply chain. Granted that typically organizations are part of multiple supply chains, but look at each of the supply chains as one individual unit and then move on. So that's a bit of backdrop in terms of how supply chain itself came into existence. Now we will take a bit of a deep dive into how would a typical connection between various entities in a supply chain work, right? So take a simple scenario where you have a customer here who is being served by, let's say, a manufacturer who is being served by a supplier. The triangles that you see here are the inventories of materials, and the hexagons that you see is the inventory of cash, which is basically cash balance, right? So a typical transaction between, if you want to see, looks like this, right? So customer places an order for receiving some material, and then your manufacturer supplies the material. So there is this information flow, and there is this material flow. And the trading partner, in turn, will have to replenish the stock that he had used up in selling to customers. So he will in turn place an order to stock on supplier, who from his inventory balance will supply the material, and trading partner stock is back up again. But this is only 50% of the story, right? For the supply chain to be completed, is only 50% of the story. The other 50% of the story is the payment itself, right? I mean, so having supplied the item, the trading partner will send an invoice to the customer, and the customer makes the payment. And so from his cash balance, the cash balance moves to the trading partner. Likewise, trading partner has bought it from supplier, therefore supplier places an invoice on the trading partner for making the payment, and trading partner makes the payment. So this completes the whole cycle of really a full transaction in a supply chain. Unfortunately, the point of this presentation is that unfortunately the supply chain managers conventionally are completely blind to this part of the flow, which a progressive and a good supply chain organization is paying attention to. Now, just for the information, I mean, from a terminology standpoint, typically orders cause material to flow from seller to buyers. So the example is the order is causing the material from moving from the supplier to the buyer here. Similarly, this order is causing the material to move from supplier to this customer here. And invoices cause the cash to flow from buyers to sellers. So while this is a simplistic view, really, there are many other flows that we can think of in supply chains. This only shows the forward flows. There are occasionally reverse transactions also that occur, which is if the material is bad or is not what is being ordered or whatever it is, then that will have to be returned. And what we saw here is a transactional view. There is also a planning view, right? How much of cash balance should an entity should have at their particular part of the network is a result of an exercise called planning. Planning is done over different horizons. So if, let's say, I'm doing a planning for coming 1 quarter, how much of sales am I anticipating to make? What is the capacity that I should have here so that I can achieve the desired service levels? These are all the questions that every entity will have to ask and accordingly prepare themselves. But none of these questions are in isolation, right? So what the customer does has an impact in the planning of trading partner, and which in turn has an impact in the planning of the supplier, right? So that is the connection that exists even at the planning level. So we looked at the connections between various entities in supply chain network, from material flow and cash flow, and we are all at the transaction level, and we also looked at the connection that exists at the planning level. So when the supply chain is integrated across all these levels for all kinds of transactions, we can say that it is a fairly well organized or a synchronized kind of supply chain. Those supply chains clearly will be at a more competitive advantage as against the ones that are broken supply chains, so to speak. Making the picture a little more complicated, what we saw were only 2-3 entities, but in real world, we all practitioners here, we all know that there are many entities that exist in a typical network. So say, for example, a customer is being served by a reseller, who is being served by a distributor, who in turn is being served by a factory, and finally by a supplier. There are other entities that are part of your typical supply chain network, which we are calling as nominal trading partners. These guys can be of the types, few examples, right? So logistics service providers, you see that the material movement from one entity to another entity is more often than not done by some third party entity. Very rarely would companies have a fleet of their own vehicles to move all their inventory from upstream to downstream, right? So therefore, how well is a LSP integrated with the network is going to give raise to the synchronous flow of material. But as I said in my previous slide, that's only 50% of the story. There is money movement also that is involved, that is typically handled, once again, very rarely does a B2B payment occur directly from account to account. I mean, more often than not, it is from bank to bank. So there are financial service providers such as banks, sometimes other kinds of financial service providers like insurers and credit providers are also there. These people are the so-called provide the engines for the smooth flow of cash from various among various echelons of the supply chain. Lastly, you have information flow also. We tend to ignore this once again. Information flow doesn't occur automatically. Organizations have to invest in information systems, not only within the four walls of their company, but also have some kind of a connections between the various network partners, right? So at the very best situation, it can be completely automated through the usage of APIs and some kind of a push mechanism, by making sure that the network is is always on. Or next best is push information between echelons through batch mode, using some kind of a file transfer mechanism, or the very early stage, what do you call, integration, which is simply sending the files back and forth, right? So this information flow between various echelons also needs to be considered by the supply chain managers. Um, there are times when the information flow proves to be a bottleneck in actually running a supply chain to its capacity. Okay, so this is the full, supply chain management side of the story. Now let me move on to the finance side of it. I mean, that was a prelude for us to make sure that what we are talking in the rest of the slides. So according to Global Supply Chain Finance Forum, supply chain finance is defined as the use of financing and risk mitigation practices to optimize the management of working capital and liquidity invested in supply chain processes and transactions, right? So so this is one part of the definition. uh, Important part of the definition is also that the visibility of underlying trade flows by finance providers, here finance providers are the ones that are providing supply chain finance, is a necessity or is necessary component of such financing arrangements, which could be enabled by a technology platform. I think this sentence separates the conventional working capital financing by banks with the more modern supply chain financing that we are talking today, right? So how is it different from the conventional financing? Let me just take a second here and clarify to the participants here. Is conventionally banks would, for a given invoice or for a given so-called letter of credit, they will provide the credit and make the payment for individual transaction, or sometimes they provide working capital finance. For either of these, the underlying trade flow, by trade flow I mean the material flow, from what stage of production to what next stage of production has it moved, has it left the factory, and is it with the transporter? If it is with the transporter, at what stage is it in, and has it been received by the entity, or is it in the warehouse? So this kind of material flow is hardly part of the conventional financing by the banks. However, supply chain finance is closely, so if you recall my two slides back, where I have said that for the transaction to be complete, material and information flow both should be occurring, or that connection between material and cash flow should be established. So in supply chain finance parlance, in a supply chain finance solution, the material movement and along with it the cash movement is well connected, and this is normally achieved, in fact it is impossible to achieve without appropriate technology platform. So therefore, over time, we all know that in the recent past there have been substantial advancements in technology, and that has really aided the connection between the ERP flows and the cash flows outside organizations. More about it as I move along, but I think that is the clear difference between conventional financing and supply chain financing. Let's move on. Before I do that, let's get a very basic understanding of how would how would the supply chain finance benefit the players that are there. So take a situation where there is a buyer and a supplier. Yeah, supplier supplies an item worth $6 million and submits that invoice to the buyer. So in the industry that we are looking at, this is an example. the general payment terms are 75 days. However, because of the good terms that exist between this buyer and supplier, buyer agrees for a 45 days payment. The annual financing rates, basically the working capital or short-term rates faced by individual entities, we clearly know that is different for different players for based on the risk perception by the banks. So the supplier, usually who is a small guy, without any supply chain finance support, is facing interest rate of 12%. But with the supply chain finance support, what is that support? I'll talk about in a minute. Is 6%. So the rate sort of comes down, and buyer, typically being a big guy with a steady, sales and steady cash flow, and better reputation and so on and so forth, he is likely to enjoy a far lower cost of capital, which is at 5%, let's say. So this is the piece of information that we have. So right now, let's look at the current situation and what is the cost of such transaction, right? Now, we are just looking at the cost of the financing cost is what we are looking at. We are not looking at any other cost. So look at this diagram here. So on day 0, item is supplied. So item has reached this one, and $6 million invoice is presented, right, by the supplier to the buyer. The invoice is approved. So day 0 all the way to 45. And on the 45th day, the invoice is paid by the buyer, right? So since the industry terms is 75 days, so let's do the total cost over 75 days. So from 45th day to 75th day, the $6 million that the buyer has paid in advance from 75 days perspective, he incurs a cost of 25,000, which is basically this 30 days. So 75 minus 45, 30 days at 5% over $6 million. If you do that calculation, that is what you will get. So 25,000. And what about our supplier? Supplier is holding, or he is invested that $6 million. He needs to receive it, and he receives it from day 0 on the 45th day. So for this entire duration of 45 days, he is having to pay at 12% on 6 million, right? So if you do your maths, you will get that to be totally 90,000. So the total cost of this financing is 115,000. All right. So this is situation 1. Now, because the industry is, asking for 75 days, the buyer decides that I should also extend my payment to the supplier, right? I mean, extend the due date to my supplier. And let's say he says that, I want to extend the payment by 15 more days. So instead of making payment on the 45th day, I will make the payment on the 60th day. So while it may be a good thing from the buyer standpoint, and we will see that buyer's cost actually goes down. So what he was making 25,000, because he's now making only for 15 days, his cost of financing is only 12,500. But if you look at the whole transaction, including the supplier for the same 15 days, he is having to pay at 12%, correct? And that 12% implies that his cost actually goes up from earlier 90,000 to total 120,000. So therefore, the arrangement is a win-lose arrangement, if you can see here, right? So the buyer ends up getting a better deal, but the supplier ends up getting the raw deal, right? And this is the story of many of small SMEs that we have all around us, and they need some kind of a supporting hand. I mean, if a supplier is constantly facing a situation like this, clearly they are facing what is called as a bankruptcy situation, correct? So what is the solution? So buyer can work with his banks. I'm just talking about one of the SCF solutions, can work with his bank. He says that, you see, I have inspected the material and this invoice is approved. Just that, according to my terms, it is due to be paid only, few days hence. But as far as I am concerned, I will certainly pay. So it is my word. Therefore, the creditworthy buyer informs the banker that my invoice, my approved invoice, is a proof that you will receive the payment. So therefore, have a arrangement, supply chain finance arrangement, to lend or to pay the suppliers much ahead of time at a far lower rate, right? So you will get some discount or whatever it is, right? So supplier with 6% SCF, so the rate for the supplier has gone down by 6%. mind you that the 6% reduction, or the supplier's cost of financing coming down to 6% is not across the board. That is, if supplier is doing business with other buyers, for other buyers he will still continue to have this 12%. It's only for the specific buyer who is offering that SCF, this 6% holds. All right, let me move on. So with the new arrangement, both people stand to gain, right? So the supplier will only have to fund the 6 million for 10 days. As soon as the invoice is approved, his cost will switch to 6% as against 12%. So at that number, you will see that even if he receives the payment on the 60th day, his total cost is 70,000, which is far less than the 90,000 that he was paying before, and buyer continues to enjoy a lower cost, right? So totally the supply chain is at a stands to gain. So this is really the economic rationale of supply chain finance, right? So with this, I mean, essentially this is the core. There are a number of mechanisms that are being put in place by various entities to make this thing happen. I'm moving on. So yeah, I mean, various entities that exist as part of a supply chain transaction will collectively, their benefits must exceed their cost for a SCF transaction to occur. So for example, if we take a simple situation of just a bank, supplier, and the logistics service provider and the buyer, right? So collectively, the benefits of these four entities must exceed the costs of these four entities. That is for all the four entities to enter into a supply chain financing agreement. Individually also, the cost of each of these entities must also exceed, or sorry, benefits must also exceed the cost. Only then it is for each of these entities. Now, when we talk about these costs and benefits, it is also important to look at not just the quantitative side of the story. As in my previous slide, I just showed you the economics, that is the number side of the story. But there are qualitative parts also that are important from a supply chain management perspective. Couple of things, I mean, you all agree once again, as a
I have one
practitioner.
question here.
Yes, sure.
So
Yes,
basically, it's very interesting topic for me at least.
Yeah.
See, since we are trying to build supply chain, multi-echelon supply chain business networks, okay? So to connect all our solutions. Now, supply chain finance is something which I keep thinking about it. Now, based on your explanation, what I see is, so along with the logistic transactions, which could be your order fulfillment and the inventory movement and and all those supply chain processes, material transaction processes. So based on that, after invoice raising by individual supply chain partner, so there could be extended application for supply chain finance that can where the financing partners can be involved, and then they can also play a role to provide financing options for supply chain companies. So if that is the case, actually, it's not only material flow and information flow. You can streamline your financial flows. That will be wonderful.
Exactly.
That will be wonderful. Is that something? I think it's not there in India at the moment. So, but this is going to come course of time. Yeah.
So there is a move now. Practically, most companies, banks are having what they call as supply chain finance solutions. You can go into ICICI website. They have a list of solutions that they offer to their customers as trade finance, supply chain finance solutions. Likewise, Bank of Baroda has, Citibank has, and so these people have solutions. The thing is, achieving that synchronous connection between material information and cash flow. For that to happen, the platform side is an important role. So what you see here, right? So it is through this platform that connection is established. There are fintech companies, Abdul Garu, that are in the recent past few years that have sort of come up even in India. I think there is a company by name Credo or some such company that arranges for receivables financing for SMEs. they can the SMEs can load the invoices, approved invoices on the platform, and the platform invites, it can be separate bankers or it can be individuals like you and me who can go and put our money, which can be used for financing the receivables. What as investors like you and me get, so it's a marketplace arrangement, right? So what investors like you and me get is at a higher rate of interest than what a bank offers, so we are better off. And what these people get, the SME people, what they get is a rate lower than what the bank would otherwise offer. So by getting the people that and people that are in need of money, that is investors like you and me, people at large, and SMEs, getting them on a single platform, these platforms are really adding value to the whole scheme of things. And they do, the platform does the connection. So is this invoice really valid invoice? Is it really approved by the buyer? That kind of a verification validation is something that the platform is supposed to do. And if that is in place, then the money is in a trustworthy place. If it is not, then we have a difficult situation there.
Perfect. Yeah, please proceed.
Right, sir. Okay. So so SCF is emerging to be a fairly large ecosystem. So what a typical supply chain managers like you and me will normally look at only the bottom here, right? Supplier, buyer, distributor, and that's all that we look at. Actually, the finance flow is getting bigger and bigger. So there are third-party providers like your funders, platform providers, sometimes investors like ordinary people. And then we have our conventional, finance providers like banks, credit insurance. These are the people that are on the full service SCF providers. On top of this, even at a higher level, there are industry associations. There are, I believe, industry associations like CII and people like that are also working towards having better SCF solutions for the better life of SMEs. There is a regulator. So RBI has come up with this a couple of years back, mechanism called TRADOS, so which is essentially to have SMEs load their invoices on the. So TRADOS is a regulatory body that allows the platforms that I showed you in my previous slide in India to be approved by RBI. So and government is slowly and gradually mandating, according to the Companies Act, people to have some kind of a mechanism on those platforms also. So essentially, I'll talk about the benefits to regulators in the long run little while later. But essentially, it is in the interest of the government also to ensure health of SMEs, and this is one mechanism to achieve the transparency and credit health of a SME segment in the whole scheme of things. Okay, so it came just about at right time. So what is while we saw a couple of slides back some economic rationale, I want to now take a broader picture and look at how individual entities in this SCF ecosystem get benefited with SCF. So firstly, suppliers, the small guys, right? So their working capital efficient, and they get access to a less expensive source of financing. Payment is secured because there is a third entity that is here that is providing SCF. There is literally no chance of late payments. Default doesn't happen. And because they're receiving payment in time, because thanks to the SCF, by anchors here, I'm talking about the SCF partners. So their relations with the SCF partners improves, and because their working capital is now being rotated in a much better manner, in a much better relationship, they can clearly look at expanding their sales and getting growth, and they get this off balance sheet financing, which is basically the receivables financing. So this is net benefits for the suppliers. And for the network orchestrator, that is any supply chain usually has one big player, right? That big player is the guy who actually dictates terms both to its suppliers as well to the distributor and retailers, right? So what is the benefit to such a large player? So clearly, obviously, his own working capital, I mean, that company's own working capital efficiency improves. More importantly, his supply chain becomes far more stable. That is, um, at least any financial distress induced disruptions in the upstream are avoided because the suppliers to his supply chain are having access to funds to pay for their working capital or pay for their employees and their own suppliers. They have access to funds, and it's a big advantage. Many a times, because the supplier goes down, the supply chain goes down, right? So that is generally avoided. Positive impact on profitability and other KPIs. Administration cost goes down. I mean, we don't pay attention to this, but if you look at a procure to pay process of a given company, the invoices reconciliation and the payment is a big headcount item. Abdulgar will vouch for this. Typically, if you're an organization of 100 crore company and you're having to deal with maybe 1,000 invoices per month, your finance department is bulging. I mean, it will have at least about 50, 60 people who are doing this three-way matching of invoice, goods receipt note, and then approving, not approving. It's a big administrative activity. So if part of it is now being done directly by bank, because you are having all your invoices sent to them and who are going to make the payment, part of that load gets reduced. Better links with supply chain partners and business growth opportunities. For banks, okay, I mean, one might think that it looks like a losing proposition to the banks, but it is really not. Uh, what, if bank was directly giving funding to the supplier, they would have got 12%, but now they are having to make 6%. But there is much more for a bank to gain. If you see here, some advantages are like this, right? So clearly, it will have a better relation with your anchors because they are doing much more business with them, broader customer base, and low acquisition cost. So the suppliers to whom with whom the bank is getting entered into in terms of making payments, it's a free relationship, right? I mean, otherwise that supplier would have gone to some other bank for its working capital financing, but because it is entered into a SCF agreement, all the suppliers to the anchor are automatically customers to the bank. And these once we all know, if we are a customer to a bank, they have our contact details and they can push additional products to us, right? So it's a customer being acquired with zero acquisition cost. So which is certainly clearly a advantage to the bank. And other things like your stable and low risk revenue stream based on high quality. So clearly, an approved invoice by a reputable buyer implies that there is going to be a far lower risk in terms of default as against unknown transactions that a typical bank enters into, right? So a low risk revenue stream is always something that a bank is always looking for, and cross sell potential. From government standpoint, it is clearly also advantageous. If you see, SMEs are getting included from a financial perspective. The overall systemic risks come down because everybody has access to cheap and relevant funds. There is competition that is coming in the financial sector because of multiple entities that are vying to provide the SCF solutions to the suppliers, and more competition automatically means better customer service, and also potentially less number of what do you call frauds or things like that. Improved sustainability of value chains due to full transparency of financial and physical processes. The digitization, all these drives that we have seen recently by the Indian government also, in terms of making sure all the transactions occur above board. Now, imagine companies entering into SCF agreement, automatically their money and material transactions are linked. Therefore, there is no way to have money transfer, so to speak. Unaccounted for money transfer gets reduced, right? So these are some of the benefits for the regulator also. Let me move on. So this is a quick, how would our company look at what is the benefit to us? So one is the monetary benefits we saw, but other things such as reduced risk, better relationship, access to higher growth. These all are aspects that are difficult for us to quantify, and that also will have to be thought about when I am entering into agreement. So this is your benefits. These are the costs. If there is a net difference, then you have a net benefit. Okay, one might tend to think that the supply chain finance comes into being only when the item has been sold. It is really not the case. I mean, throughout the value chain, there is a possibility of injecting a supply chain solution, supply chain finance solution. So moving from left to right, right? So this is how typically material moves through value chain, right? So you have a raw material, you have production, you have finished goods, and then that is in transit, and then it is received in the customer end, and customer acknowledges it, and then it becomes its payable, and then so this is a whole value chain, right? And what you see here are various supply chain finance solutions that are relevant and can be used at these entities. So if you have a raw material that is procured to meet a certain purchase order, then there are supply chain finance solutions that can be used to obtain finance for that raw material at a cost lower than what a typical working capital cost would be. So they are termed as, I'm not describing each of these terms. I mean, that itself is a big lecture in itself. There are, of course, at the end of the session, I'm going to show you some resources which you could go to for getting the definitions of each of these terms. So these are some SCF solutions across, in pre-shipment, during in-transit, and post-shipment. One point I want to bring to your attention here is that the light blue color here is what is called as loan based. What is the meaning of this? The meaning of this is the funding that the supplier will receive from the bank is against inventory, right? The inventory could be of whatever form. It can be raw material, WIP, or finished good, and whichever location. That can be in my inbound storage area, or it can be within my factory, or it can be in my bonded warehouse, or any such place, right? So net, the entire the basic premise on which the financial service provider will give me SCF is against the inventory that exists. And the dark blue here that you see here is all against receivable purchase based. The light blue color SCF isn't very new to us. I mean, in the sense that it is not a modern invention. It has been there, and partially companies have been taking advantage of this kind of financing already. But what is relatively new and made possible because of advent of technology is the dark blue, which is receivable purchase finance. And some examples are on the receivable side, factoring, forfeiting, receivable discounting, and on the payable side, payable finance or dynamic discounting are some examples, right? So up to here, what you see from the raw material stage till receivables, typically if there is a financing that is sought by, that is led by suppliers. So therefore, these solutions are called supplier-led solutions. Once the item has been received at the buyer, that is the customer can also drive SCF solutions, and because it is now an official payable by the buyer to the supplier, the buyer is working with the banks in financing the supplier, which is still looking like a receivable in their eye, right? So they are called as buyer-led. Most new development is occurring in the buyer-led financing. Conventional financing has been around in the supplier-led financing. Let me move on. So this is, in a nutshell, what is supply chain finance, and why should we care about supply chain finance is what I'm going to talk about for a couple of minutes here. Very broadly, I mean, typically a company's working capital is a function of its inflows which comes from banks. I borrow from banks, and my customers make payments to me. So this is the positive flows into my working capital, and the negative flows are I make payments to my suppliers, I make payments, I mean salaries to my employees, and I make other payments such as rent, utilities, insurance, electricity, and things. Right. So the net effect of this inflow and outflow, so long you are positive on your cash balance, you're doing okay. But any disruption in terms of your receipts or in terms of your payments, if there is a mismatch, and that causes what do you call a situation where you are running out of cash, that's a very bad situation for any company to be in. In fact, by regulation, if there is any payment that is due to be made and it is not being made for longer than 60 days, then government has every right to declare this company as bankrupt and take over the charge. So the bankruptcy laws are fairly stringent in most of the countries. So that being the case, cash management is extremely important. Yet it is for some reason is a prerogative of finance department, which doesn't very closely interact with the supply chain department. My talk here is to educate, I mean, both the departments, so to speak, that you need to work in tandem. The agreements, transactions that we have upstream and downstream, and the impact of that on cash are something that you can't divorce and look at them individually. That is my story. Then, particularly, there are enough reports that talk about the plight of SMEs in different countries. This is from a report by IBA for the SMEs in the European Union. A bit dated information, but still, it is a similar story everywhere. So in the 27 countries consisting of European Union, which has about 22 million SMEs, the largest enterprises are only 0.2% and 99.8% is in terms of the number SMEs, right? And in terms of the GDP contribution, 50% roughly is contributed by SMEs and 50% is by large enterprises. If you look at the employment offered, large enterprises actually fall short. They offer a much lesser employment at 35%, whereas SMEs offer much higher employment at 65%. So I think we can very easily say that this story is the same even in India, right? You have SMEs, large number of them, contributing in a big way to the GDP, contributing in a big way to the employment. Yet at the same time, when it comes to the access to the funds, they are at the. So if you see here, I mean, my title of the slide, in a supply chain, SMEs are the first people to spend. They are the ones that will convert the raw material into components or whatever they have already spent, and they'll send the components to its upstream. Upstream guy will assemble it into making to a finished product, and finished product is goes into distributor, retailer, and finally it sort of gets sold. There may be some agreement in terms of making early payment, but if you really see, these people, the smaller guys, are the first one to spend, but they're the last one to receive. So their money is blocked in the system for far longer than proportionate. That is point number one. Second important point is that we all know that supply chains don't face demand that can be predicted very easily, right? I mean, yet at the same time, you need to make to forecast. So once again, since SMEs are at the very upstream end, they are making things to forecast. And the ones, the entities that are at the closer to the customer, they are making things to order, right? So their chances of converting or making the right product and get the money is much better as against the SMEs which are making to forecast, right? So by the virtue of the distance that a SME has from the end customer, their money and cash and material investments are not matched very accurately. So that adds to the challenge that a typical SME has. And you have other challenges like energy cost, raw material cost, and any other disruptions like this, right? More third thing is the larger enterprises that are part of networks are always pushing for elongated, extended payment terms with the suppliers. I believe there is a law that certainly is there in UK, and I think in US also, is that one can't officially, I mean, one can't force delayed payment. I mean, or can't have an extended payment terms beyond 60 days. So there are some such rules that are coming into play to force enterprises not to arm twist SMEs. So, but yeah, I mean, the regulation goes only so far. So this is one of the reasons as to why we should keep SMEs alive, and how they are playing an important role in our supply chain management, and therefore the bigger players in supply chain, what I'm calling as anchors, their role needs to evolve beyond just ensuring supplies, but ensuring the long-term survival of smaller entities that exist in its network, right? So for their own benefit, I mean, if they go down because of financial reasons, I mean, it's possible that you can look for an alternate supplier in the short run, but if that's the kind of business model that one is going after, clearly the relationship is not going to last longer. So this is in net. Why is it that we as supply chain managers should care for SCF is what I talked about. Quickly, what kind of solutions that exist, I'll talk about, and then finally the state of art. So if it is seller oriented, then accounts receivables solutions exist. If it is inventory oriented, then these are the what do you call solutions that exist, and buyer oriented are account payable solutions. So okay, I think Abdul Garu, given the time constraint, what I would want to do is skip these what do you call flow charts, leave them for participants to go through by themselves. I'll move to my last section. Is that okay?
Yeah, that is better. Yeah.
All right. Okay. So this flow chart talks about if you are financing your accounts receivables, then what kind of solutions exist and what is your decision tree. That is what is being talked about. So there are a number of solutions like collective invoices, securitization, factorization. So there is a way of approaching it. This decision tree is talking about. Similarly, for inventory financing, is it fixed or current asset? There are solutions that are available. You can finance your fixed assets also. For that, there are solutions like sale and leaseback. Then finally, payables. Once again, simple solutions like such as P cards, all the way to complex solutions like reverse securitization. They exist, which depend on what kind of transaction value you are looking at. Are you looking at going to the marketplace, or are you looking at just going to a bank, and then, or you're just doing the financing between yourself and your supplier directly, instead of having a third party coming into play. So depending on what arrangement you're looking at, various solutions are available, and technology also is aiding. So the current state of art, right? So this is a study by ICC, International Chamber of Commerce, along with BCG Group, and the projection for various types of finance is captured here for the global trade. So open account is basically the buying and selling that happens without any bank coming into play. So that is a conventional, traditional kind of buying and selling that we're looking at. According to the study, is anticipated to grow at 4.4% CAGR. Then documentary trade is the conventional, that is LC's working capital financing, that all that I talked about, is expected to grow at 3%. And the supply chain finance, which is largely buyer led, is going to grow at 4%, is what that this study talks about. So there is a pie for banks to look at and then jump into the solutioning, but they won't be able to do all by themselves. They need a right platform also. Okay, so according to a McKinsey study here, as I've been talking about, so of the 7.3 trillion supply chain total trade, The documentary business, the conventional business, still accounts for a large part, which is 3.8, but that is not growing too fast. I mean, that is the situation number one. Seller side financing. So I am the one who is supplying, and I am the one who is in need of converting my receivables into cash as quickly as possible. These solutions have also existed in terms of discounting and things like that. So a seller works with various buyers, gets the invoice, so basically invoices approved, so to speak, and then he finds a funder and then works with him in obtaining, getting a borrow against my receivables. So that this also is a kind of solution that have been out there in different markets, and they have been growing at about 3 to 5%. What is really growing fast are buyer-led supply chain financing, and that two types of solutions. One is called as reverse factoring, and other is called as dynamic discounting. So if you see a diagram here, what typically a reverse factoring implies is this. So there are going to be platforms that facilitate financing on the basis of buyer approved invoices. So seller supplies to the buyer, buyer receives the material, he inspects the material, finds it to his acceptance, and he says that this invoice is due to be paid. There's no problem with the invoice. I will pay it only at a certain later time. The approved invoice is loaded on the platform, and the platform works with funder. This funder can be, once again, a marketplace, that is people like you and me, with no access to the banker, or there can be banks itself. So if it is bank, then it is reverse factoring. If it is platform itself is going out in the what do you call, public at large and obtaining the finance, then it is your dynamic discount. The discounted value is a function of how close is it to the due date. The closest to the due date, the discounting is far lesser. But if the supplier is asking to be paid much ahead of the due date, then the discounting will be much steeper. So that is how things work. Conventional financing, there are challenges. Bank will only discount invoices with established SMEs. It's a very labor-intensive process. Each invoice will have to be verified by the bank. Banks will focus only on large tickets, given that it's a laborious process, and banks will charge a higher rate in any case. So this is our conventional system, but is sort of getting overhauled because of much of these activities that are being done in a physical basis are now being done on platform. Things are changing, but banks need to get their act in place quickly enough. The fintechs are out there already providing solutions. In fact, I mean, one of the fears that banks have is that part of their working capital financing business is being taken out by the modern fintechs that are out there. How the whole thing will emerge out to be is anybody's guess. But I think the banks that are getting their act together in place are the ones that will eventually win. So global cost of goods sold is so much, according to the same McKinsey report. Even if for various reasons listed here, $48 trillion is excluded from SCF programs, you still have about large market that still needs to be catered. So once again, the clear point here is that across markets, and typically for growing markets like India, supply chain finance is clearly a growth opportunity, both for technology solution providers as well for finance guys. And of course, supply chain managers will need to push the other stakeholders to offer these solutions. So it's an opportunity, not market, not worth ignoring by various stakeholders. A lot of models exist. Banks themselves doing the whole end-to-end, that is connecting the physical flow through ERP all the way to credit decisioning and credit resourcing. This model isn't very prevalent. What are prevalent are some kind of a hybrid models with fintech, ERP, and banks getting integrated. So this slide talks about how different models work, and for each of the model to work, what should be in place. So for example, if bank is going to do entire thing all by themselves, then they have to invest in technology platform. They'll have to reimagine their relationship with their buyers and customers, have some kind of APIs that flow into this platform, have security arrangement. All of that should be in place. if a fintech is going to be there, then some kind of an integration mechanism that needs to be in place, right? So there are these four models that McKinsey sort of came up with. I am seeing in India, at least, all of these models in some form are being experimented out there in the market. Your particularly fintech SaaS-based models and blockchain to ensure the guarantee of tracing of the transaction. Blockchain has clearly a use case in supply chain finance, and SaaS-based models are becoming more popular because you don't need an in-house what do you call in-premise solution. And in any case, I mean, you need more people on the platform. So onboarding people on the platform, it works best if it is a SaaS-based solution. So a lot of SCF solutions that are offering solutions on SaaS are on the rise. And some resources that you could go to for more information on technical terms and how individual solutions work, what are the pros and cons of individual solutions are out listed here. So you're welcome to go here, and that's the end of my presentation.
So very
sorry,
interesting.
5 minutes extra,
No
but
problem.
yeah.
Dr. Kalyan Garu, it's very interesting.
Yeah.
One of the most important thing is the supply chain management. When you talk about the sky is the limit. Okay, so
Yeah.
basically here, when you talk about the latest trends in supply chain, so supply chain finance is one of the area where there is a lot of scope for the companies. Because one of the key problem in mid-size organization, even if it is in the larger organization, is the terms of payment. Okay, is the terms of payment, and then the cash working capital requirements. So even though they have a good business model, they have a good products and solutions. From finance side, the organizations are taking a hit. Okay, so that's where the supply chain finance awareness adds a lot of value. That's the reason I requested you, Dr. Kalyan Garu, to join the session, and it's very interesting. It's always a learning session from you. Due to time constraint, I'll just collect the questions and post you offline, and then then we can always connect and discuss with our participants. Okay, sir. Okay.
Definitely, Abdul Garu. Yes.
So
Yes.
thank you, Dr. Kalyan. A wonderful lecture on a wonderful topic as usual. So it's so thank you very much, and thank you for your effort and excellent presentation, Dr. Kalyan. Thank you very much.
All right. Bye-bye. I wish the conference very best of success.
Thank you, sir, and it's going very well so far.